In Chapter 9, we also have a look at multi-period and estimated liabilities and contingent liabilities. In addition to our known liabilities, we also may have to estimate certain liabilities. To estimate a liability, we must know that we have an obligation, but are uncertain as to exactly how much will have to be paid or when it will be paid. The amounts involved must be subject to reasonable estimation before we may actually record an estimated liability. Estimated liabilities are very common in business. Examples that come to mind include employee benefits such as pensions, health care, and vacation pay, and warranties offered by a seller. Many companies provide employee benefits beyond salaries and wages, as we've learned. An employer often pays all or part of medical, dental, life, and disability insurance. Many employers also contribute to pension plans, which are agreements by employers to provide benefits or payments to employees after retirement. These will all be estimated using current information. As you know, they are only an estimate because we have no way of saying for certain how much the cost will be, but we can come reasonably close. To illustrate, assume that an employer agrees to pay an amount for medical insurance equal to $8,000 and to contribute an additional 10% of the employee's $120,000 in gross salaries to a retirement program. An entry to record these accrued benefits is showed here. They will be reported as an expense on the income statement, and the estimated liabilities will be reported on the balance sheet. Now, many products sold are covered by a warranty. The seller is liable for replacing or repairing the product while it is under warranty. To make sure we follow the matching principle, we must report the estimated warranty expense in the year in which the sale is made. In this way, we are matching expenses with revenues. We need to be careful, though, when we record actually performing the warranty work. The liability is reduced, but expense is not recorded again. Here's a great example. A dealer sells a used car for $16,000 on December 1st, 2015. The car has a maximum 1-year or 12,000-mile warranty covering parts. This dealer's experience shows that the warranty expense averages about 4% of a car's selling price, or $640 in this case, which is 16,000 times 4%. Let's look at the proper accounting for the estimated warranty expense. On the date of sale, December 1st, the dealership will debit warranty expense and credit the current liability account, estimated warranty liability, for $640. The amount of the estimated liability is determined by multiplying $16,000 selling price of the car times the 4% historical warranty cost percentage. To further extend this example, suppose the customer returns the car for warranty repairs on January 9, 2016. The dealer performs this work by replacing parts costing $200. On January 9, 2016, the dealership will debit or reduce estimated warranty liability for total cost of $200 and will credit auto parts inventory for $200. This entry reduces the balance of the estimated warranty liability. Warranty expense, however, was previously recorded in 2015, the year the car was sold with the warranty. Notice that no entry is made to record expense in 2016 when the warranty work is done. In the final section of our video series on current liabilities, we will look at contingent liabilities. A contingent liability is a potential liability whose outcome depends on the occurrence of some future event. If the future event occurs, we have a definite liability. We've prepared this table to help you determine the proper accounting for contingent liabilities. First, we must assess the probability of a future sacrifice and then determine if the amount involved can be estimated. Our assessment of future sacrifice must be placed in one of three categories. It is 1, probable that we have a future sacrifice. 2, it is reasonably possible that we will have a future sacrifice. Or 3, there is only a remote probability of a future sacrifice. You can see that if we assess the probability as remote, no action is required by the accountant. When we assess the probability as reasonably possible, we must first disclose the contingent liability in the notes to the financials. And then finally, if the probability of a future sacrifice is probable, we will record a contingent liability in the amount of the sacrifice if it can be estimated. If we cannot estimate the amount involved, we must disclose a contingent liability in the notes to the financial statements. Two common examples of contingent liabilities are potential legal claims resulting from lawsuits made against the company and debt guarantees. When a company guarantees the debt of an affiliated company, it may eventually have to pay the obligation. If the original debtor fails to pay, the obligation becomes the responsibility of the guarantor. If the future event is reasonably possible, meaning it could occur, we disclose information about this type of contingent liability in the notes to the financial statements. If it's probable that a payment will be made, then the amount is recorded as a liability in the financial statements. A company incurs interest expense on many of its current and long-term liabilities. Examples included short-term notes and the current portion of long-term liabilities, as well as its long-term notes and bonds. Interest expense is often viewed as a fixed expense because the amount of these liabilities is likely to remain in one form or another for a substantial period of time. This means the amount of interest is unlikely to vary due to changes in sales or other operating activities. While fixed expenses can be advantageous when the company is growing, they create risk, and this risk stems from the possibility that a company might be unable to pay fixed expenses if sales decline. Companies that loan money to a business want to be assured that the principal and interest will be paid when it's due. One measure that helps creditors assess the risk of a loan is the times interest earned ratio. We calculate the ratio by dividing income before interest and income taxes by interest expense. And as an aside, income before interest and income taxes is sometimes referred to as operating income. I hope this chapter was informative and practical for you. In the next chapter, we will learn more about accounting for liabilities, but this time focusing on those liabilities that are paid off over a long period of time.